Social media is full of traders claiming they turned pocket change into a luxury lifestyle, while others insist you need a massive bankroll to participate. This creates a difficult choice for the beginner. Do you attempt to build wealth with a small amount, or accept that the money might simply disappear into the market? To be clear, a universal starting figure that works for every beginner simply does not exist. Broker minimums are often misleading. They don't represent the actual capital required to execute a sustainable, active trading strategy. Passive long-term investing has become accessible through fractional shares, but active daily trading requires significant liquidity to handle transaction costs and price volatility. Strategic competency and personal risk capacity determine when a trader is truly ready to enter the market, regardless of a broker's deposit rules. Instead of searching for an absolute minimum, you need to identify the specific amount of money you can responsibly risk while navigating the learning curve. This chart shows the relationship between account size and emotional pressure. As available capital decreases, the internal pressure to perform rises. In the top left quadrant, low balances trigger a compulsion to grow the account quickly, placing the trader in a high-danger emotional state. Professional risk management requires a heavy boundary between risk capital and survival capital. Your trading funds should be entirely separate from money earmarked for rent, utilities, and emergency savings. Trading with essential living money invites disaster. The fear of losing funds needed for basic survival makes rational, calm decision-making nearly impossible. Let's evaluate a common starting point: the micro account with a balance of approximately $100. This comparison matrix tracks 3 starting tiers: $100, $1,000, and $5,000 or more, against the factors that determine long-term viability. A $100 account offers a safe environment to learn platform mechanics. Losses here have a minimal financial impact, providing a low-stakes way to practice entering and exiting trades. However, the low dollar amounts often lead to frustration. A successful 5% gain only yields $5, which can feel insignificant and drive a trader toward reckless behavior to see real money. This lack of meaningful profit often tempts beginners to use broker-provided leverage to artificially inflate their buying power, hoping to turn those small moves into larger returns. Leverage is a double-edged sword that swings both ways with equal intensity. A minor fluctuation in the market can instantly liquidate a small account when that position is over-leveraged. While a micro account limits the total dollars you can lose, it frequently encourages toxic psychological habits and excessive risk-taking. Moving up the scale, we can evaluate mid-tier and well-capitalized accounts, ranging from $1,000 to $5,000 or more. Returning to the matrix, these higher tiers fundamentally change the structural advantages available to a new trader. These accounts provide enough mathematical room to practice professional position sizing, allowing you to manage risk without relying on dangerous levels of leverage. Proper position sizing requires calculating your maximum acceptable loss, often just 1 or 2% of the total account, before you ever determine your potential profit. The trade-off is clear. Trading larger balances without a proven strategy exposes you to heavy dollar losses that can have a lasting impact on your net worth. Simply increasing the account size will not fix a failing strategy. If you lose consistently at the $1,000 level, a $10,000 account will only result in larger losses at a faster pace. A larger account removes mathematical constraints, but it significantly increases the financial penalty for a lack of discipline. Regardless of your bank balance, starting with paper trading is a standard requirement for any novice. Simulated accounts allow for the rigorous testing of order types, strategy execution, and chart patterns without risking a single cent of real capital. However, simulators have a critical limitation. They fail to replicate the physiological panic that occurs when real money is on the line, shattering the calm of practice. Transitioning to live capital often triggers fear and hesitation. These emotions can instantly override the rational, objective decisions you made during simulated practice. Paper trading provides essential mechanical training, but it cannot simulate the brutal psychological pressure of a live market environment. Navigating these trade-offs requires a systematic roadmap that prioritizes safety before you ever risk live capital. The smart beginner path begins by assessing personal finances. Lacking an emergency fund stops the process. If secure, the path redirects to a simulator to prove your strategy. Account sunding is the final step. Establish maximum risk and an exit plan before allocating any dollars. Traders with small balances should focus exclusively on consistent percentage gains rather than specific dollar targets. Capital allocation should only increase alongside demonstrated competency, ensuring your exposure never exceeds your skill level. If you are starting with a larger balance, avoid deploying the full amount during your initial trades, simply because the capital is available. The primary goal for any beginner is weathering the initial learning curve and ensuring long-term survival in the market. This first phase is about becoming a disciplined, rational market participant who values a repeatable process over immediate, short-term profits. Always adhere to the survival capital rule. If an account loss would prevent you from meeting your basic financial obligations, your risk level is already too high. Sustained success depends on a rigorous commitment to education and risk management, which serves as a far more reliable foundation than the size of a starting deposit.